Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Woodside Petroleum stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Woodside is a petroleum exploration and production company. It is Australia's largest independent oil and gas company. The company replaced its CEO of 10 years just a few months ago. I can only imagine that the new CEO is praying the $11 billion Scarborough gas project is successful. The company's ex-CEO said there are no other big growth options across Western Australia, as assets are drying up. The other big projects the company has are Pluto Train 2 and Sangomar, but they are actively looking to sell those. The Scarborough gas field is on the coast of Western Australia. There is 7.3 trillion cubic feet of gas at this location. Woodside owns 75% of this project and BHP the other 25%. In August of this year, the Western Australian government approved the project, which was the big holdup as the federal government previously gave its approval. It is currently not a producing asset. The expected cost of the project is $8.5 billion to $9.7 billion. The upstream projected cost is $6 billion and the downstream cost is $2.5 to $3.7 billion. Just a few months ago in August, Woodside entered into an agreement with BHP to combine the company's oil and gas assets together. This would be an all-stock deal with Woodside owning 52% and BHP owning 48% of the combined entity. It seems that BHP wants to get away from the oil and gas business and move into things such as nickel and potash. The company is headquartered in Perth, Australia, and was founded in 1954. It trades on the Pink Sheets, Deutsche Börse, and Australian Stock Exchange. Let's get started with the model. This is a large cap company, 18 billion market cap. They're trading at $18.66 a share, and they have 970 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have positive free cash flow each year. It came down a lot in 2020 due to lower commodity prices. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was a big negative in 2020, positive in the other years. Revenue is the sales for the company, and that was over $5 billion in 18 and 19. It came way down to $3.6 billion in 2020, but it is coming back up. And for year-end 2021, the revenue should be pretty close to 2019. This is the company's income statement. The top line is the revenue, the sales. Here's a breakdown of their revenue. So a bulk of their revenue comes from Asia. So this company is really dependent on the economy in China. Here's a breakdown of their revenue by product. So liquefied natural gas is their biggest by far, $2.5 billion out of the $3.6 billion. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was lowest in 2020. It is coming back up in the trailing 12 months. But the trailing 12 months number is still a bit lower than 2018 and 19. Then below that is their operating expenses. Then below that is their operating income, which was positive in 18 and 19, a big negative in 2020 and the trailing 12 months. The reason they had negative operating income was due to a non-cash impairment loss of $5.3 billion. So this is a non-cash item, so it doesn't affect cash flow. It's a write-down of your assets. You'll see in a statement of cash flows later that they have positive operating cash flow. They do have a decent amount of debt on their balance sheet, so they paid $259 million of interest on their debt in the trailing 12 months. And the bottom line of the income statement is their net income. They did have a small positive in the trailing 12 months, a big negative in 2020. But sometimes it's hard to look at the income statement to get the true story of the company. In this case, the statement of cash flows is a lot better. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they do generate a lot of cash flow. It is going down. It was over $3 billion. Now it's around $2 billion. They of course spend a lot on capital expenditures. Operating cash flow minus capex gives you your free cash flow. They do have a good amount of free cash flow each year, so they are able to pay their investors a dividend. They did add $2 billion of stock in 2018. When a company adds stock, that dilutes the current shareholders. And they add debt, but they pay down debt as well. So in the past few years, it looks like they added a similar amount of debt as they paid down. This is the equity section of the balance sheet. They have $12 billion of equity. They raised $9 billion from selling their business, and they generated $1.4 billion from running their business. Retained earnings is a sum of all your prior net incomes minus the sum of all the dividends you paid out. So they did generate more money, but they did pay a lot out in dividends. So that's why it's only $1.4 billion. But if you added in the dividends, it will be a lot higher. Let's look at the capital structure. $12 billion of equity, $8 billion of debt. They're 61% equity, 39% debt. Their net debt is $3.8 billion. So they do have a good amount of cash on their balance sheet. And their weighted average cost of capital is 8.3%, and that's the middle whack according to Finbox, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for that's $17 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $16 billion. We divide that by 970 million shares. And we get a calculated stock price of $16.43. They're trading at $18.66, so they're trading at a 14% premium. It's a sell according to the model. The average analyst projects their revenue to decrease 2.4%. To calculate their future revenues, I decreased it 2.4% a year. And to calculate their future free cash flows, I needed to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, and I divided by these 4 revenue numbers. And that comes out to 26%. So they convert 26% of their revenue into free cash flow. So to get my future free cash flow numbers, I just multiplied the future revenue estimates by 26%. Simply, Wall Street's valuation is $11. They're also saying the stock is overvalued. 3 analysts priced this stock, and the average price target was $18. This is where the stock has been trading the past 52 weeks, so it's been all over the place. It was about $12 last year, then it got up to about $24, $25, then it came way back down to about $13, $14. Now it's coming back up close to $19. So the stock seems to move a lot. They pay a semi-annual dividend, 12 cents and 30 cents. Their dividend yield is 2.25%. which is 114% of their net income. That's because their net income is artificially low due to that large asset impairment. For this company's situation, it's better to look at the dividend payment over free cash flow, and that's 68%. Their industry pays a 4.4% dividend. They're at 2.2%. Analysts are forecasting their dividend to grow to over 5%. That's a pretty big growth from 2.2%. The only way this company can make money is if the prices of the underlying commodities it sells is above a certain price point. So you can see in the first half of 2020 versus the first half of 2021, the prices of all the commodities have increased. Liquid natural gas, 37 cents to 41. The big jump is oil, 39 cents to 74 cents. Their production in the first half of 2021 was lower than the first half of 2020. But they made a lot more money with lower production. That's because the prices were so much higher. And you could see their EBITDA increased dramatically as well. That went from $1 billion to $1.5 billion, a 50% increase. The revenue increase wasn't even close to 50%. Since most of their sales are LNG, this blue line is where their profitability lies. When it's above 40, the company's making money. When it's above 50, they're making a lot of money. For the first 3 quarters of 2020, this blue line was pretty low. That's why their revenue was so low and their net income was negative. Their beta is 1.31, so the stock moves a little more than the market. It's gone up 40% in the past 52 weeks, while the S&P is up 27%. The 52-week low was $12, the high is $21, and the stock is trading above its 50-day and 200-day moving average. Not that many people buy this stock in the US, only about 70,000 shares are traded each day. Of the 970 million shares outstanding, 959 million are on float. Their employee count is pretty steady since 2015. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $8,000 today. That's a 20% loss. So 10 years ago wouldn't have been a good time to buy the stock. If you bought it around here, or even better around here, you could have made an amazing return. The biggest shareholder is BlackRock at 6%, then Vanguard, UBS Asset Management, Commonwealth Superannuation. This is a pretty big fund that the government of Australia runs. And then State Street. Let's look at their financial ratios. Their PE is a bit high since they had pretty low net income due to that large asset impairment. Their price to sales is decent, and they have a really good price to book at 1.5. They have a low ROE at 3%. They have a pretty high current ratio and quick ratio at 2.0. They have a lot of cash on their balance sheet, $3.8 million. They're well capitalized. They generated $600 million of free cash flow in the trailing 12 months. They have $2.2 billion of working capital, and they pay out over $400 million in dividend payments, so they have $2.4 billion of funding. The best way to look at ratios is to compare them to companies in the same industry, and they all worse in PE. They're better in price to sales and price to book. They have a good current ratio. Their ROE is positive. The average is negative. They're pretty close to average in debt. They're twice the size of the average company. So to summarize, I have them trading at a 14% premium. I imagine this is a pretty popular company to invest in Australia, not so much in the US. But depending how the merger with BHP goes, it could really decide on how well this company does in the future. It could really blow up from that because they're going to have a larger asset base. And they're also going to have access to more customers through BHP. I rank their free cash flows 4 out of 10, their revenue 6 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.